start off by saying that the content and the presentation, the materials I'm presenting, it's solely my own. I don't expect to say anything controversial, but if I say anything that's in error or that anyone has an issue with, then I'm solely to blame, and you could take it up with me. Yeah. So I also feel sometimes for you Simpson fans, I'm kind of like the Troy McClure of CLE. You may remember me from various other CLE videos that are floating out there. But regardless, and thanks to all of you for showing up and giving me, 50 minutes or so of your time this afternoon. So, as Richard said, and as you can see, this subject matter is the purchase and sale of a small business. And this is intended to be basically an overview of some concepts and basically processes and workflows for these types of transactions. I've been practicing for 30 plus years, and in my time in practice, I've represented many different types of entrepreneurs, startups, buyers and sellers of businesses of all sizes and types. All of the businesses, all of the transactions I've been involved in over the years would involve businesses that are defined or described as small by the Small Business Administration, the United States Small Business Administration. And these typical transactions that I would handle would be restaurants, service providers, retail businesses. I've represented a lot of gas station buyers and sellers. I mentioned in the bio that I'm from Queens, just in case any of you may have any problems placing my accent. Also, when I first started practicing, I represented a lot of buyers and sellers in restaurants, pizzerias specifically. So these are the types of transactions that I've been involved in over the years, right? And just like in real estate, for those of you who are experienced real estate attorneys, right? Each transaction we say is unique because the subject matter is unique. And it's the same with these business transactions because even if you are representing, every restaurant is its own entity, every dry cleaners, every gas station, right? Every deal is its own thing, but the processes and the concepts and the workflows are the same, and they're really quite similar, and they'll be sort of immediately recognizable to anyone who handles real estate transactions, right? Really, all we're doing is we're substituting one type of asset, right? Instead of a house, we're selling the business assets substantially, and I'll get to this later on, substantially all of the assets that are involved in the operations of this business. So given the time constraints, this is going to be just sort of an overview, a primer, if you will, right? But again, most of what I'm talking about is going to click for those of you who are real estate attorneys or any sort of transactional attorney, right? The timelines, the processes, the workflows are going to be the same. So let me see. I'm running into an issue here with my slides here. Hold on. Yeah. Okay. So as I mentioned before, all of the transactions that I have been involved in through the years involved small businesses. And by the definition used by the Small Business Administration, most businesses in the United States are small, right? The definition that the SBA uses are firms with fewer than 500 employees. And in 2024, there were 34.8 million small businesses in the United States, and those businesses make up 99.9% of all U.S. businesses. So effectively, overwhelming majority of businesses in the U.S. are defined as small businesses. And then out of these total small businesses, approximately 28.5 million, 81.9% are non-employer firms, right? So if 999 out of 1,000 are 500 employees or less, and then 819 of those 999 are non-employer firms. So what does that mean, right? So that means a sole proprietor, right, or a family business, what we used to refer to maybe as a mom and pop business, or a business where there may be multiple owners who are shareholders or a partnership or whatever, but those are the folks who are actually performing the functions of the business, providing the services or doing whatever it is that the business does, right? And most of these non-employer firms, right, these non-employer businesses, the value, right, the transferable value of these businesses, or the value of these businesses, is not really transferable, right? It's not fungible. Think about if you are an attorney who's practicing as a solo, right? Where is the value in your practice if you were trying to sell it, right? Depending on what you do, right? Most of the value is tied or connected to the individual proprietor, right? And the whether or not there's some other thing or some other asset of value that's sellable or that's usable by a third party, right, is questionable. And in most cases, it's difficult, or there may not be any value anywhere else, right? So we're going to be talking about, or I'm going to be talking about, these transactions where essentially we are dealing with the purchase and sale of substantially all of the assets of a business, right? Other types of transactions, and I've handled these, or another type of transaction that I've handled over the years, is where we are actually involved in the purchase and sale of the ownership of the business itself, right? So if we're talking about a corporation where the purchaser is actually buying the stock, the shares of stock in the corporation, right? Or if we're talking about a limited liability company, where we're talking about buying all of the membership interest in a limited liability company. Those transactions are substantively, materially different than the asset transaction, because primarily because we're talking about not only acquiring the assets, but also taking on the liabilities, the existing liabilities of the business that's being sold, right? So the main difference, right, in the pre-contract stages of the transaction, in the stock and the stock transaction or the membership transaction, is with regards to due diligence, right? Because those transactions tend to be more complex, more costly, because of the type of due diligence that needs to be done or should be done, specifically with the assumption of liabilities, right? In the asset purchase transaction, we're really taking on only the assets, and in some cases liabilities, but typically not assuming any liabilities of the selling entity. So our diligence, right, is different, right? The diligence we are going to do is different because the risks are different, right? I'll talk about sort of crafting a diligence plan a little bit later, but just in sort of general terms, right? The amount of diligence and the type of diligence we are going to do is informed by the level of risk, right? The type of risks and the size of the risks that are present or potentially present in the transaction. The biggest deal I ever worked on, just in terms of money value, was a stock transaction and not an asset purchase transaction. And those are, again, those are much more, tend to be much more complex, right? So unless I say otherwise, I'm going to be speaking about basically the transaction where it's the substantially all of the assets of the selling business are being sold to the buyer. And for all intents and purposes, the seller is out of business once the transaction is closed or once the transaction is completed, right? So with that being said, moving on to consider starting with the basics, right? Where do we get started in the transaction? And with the most sort of basic question, the first question is what is the attorney's role? Starting with who are you representing, the buyer side or the seller side? And again, analogizing this to a real estate transaction, we know that if we're representing the buyer in a real estate transaction, we are going to be performing functions that are different from representing the seller in a real estate transaction, right? So where we fall, on which side we fall, depends on, right, or informs what it is that we are going to do, right? Deal maker or deal breaker, right? So I believe, right, that one of the primary functions of an attorney, right, or the attorney in these types of transactions, especially from the buyer's side, right, and the sort of in relation, direct relation to the next bullet point, which is, how do we add value to the transaction for our client, right, is in the identification and hopefully, right, the mitigation of risks, right? And there are risks inherent, right, in every transaction, right? We start with sort of the risks of the other side not performing, but really, especially in a business transaction, right? We're talking about risks associated with the value of the assets, right? Our clients from the buy side, I think our greatest risk from on the buy side is that what we are paying for the assets or the assets that we are acquiring are not worth what we are paying for it, right? Either from the standpoint of absolute price considerations or whether it's going to allow or permit the continued sort of exploitation of that asset for the business purposes, right? So sort of tying it back into the idea of diligence, right? If part of our function, right, is helping our client sort of identify these risks, right, then we get into sort of back to that question of, are we making these deals or breaking the deal, right? Ultimately, the decision is up to our client, right? It's our job to right, inform our client about these potential risks, and to the extent they are addressed, it can be addressed in the transaction documents, right? Then we do it. If we can't, if our client is informed of the risks and they decide to go ahead with the transaction anyway, well, then we've done our job, right? They're making a business decision based on the best information available to them, and our job is to educate them and sort of help them sort of understand what these risks are. And that's the tension, right? That's the dynamic between diligence and how we add value and protect our clients' interests as best we can. Working with other professionals, I have here brokers, right? Most of my transactional business, unlike real estate transactions, doesn't come from brokers, right? Most of the deals I work on come from referrals from other professionals, usually accountants or other types of business advisors that I have an existing relationship with, right? So they have a client who has an existing business and they want to sell their business and they need an attorney, and they're sent my way, right? Brokers, my experience working with business brokers is typically if I have an existing relationship with a client who then decides they want to sell, and then they decide to list their business with a broker who then performs, similar functions as a real estate agent, right? Business brokers tend to, if it's possible, if they're good, are involved in the transaction and facilitate the transaction in the same way and even to a greater extent than even a very good real estate broker or a real estate agent, right? And I'll revisit this when I talk about diligence from the seller side and whether, what makes sense or what a seller might do in connection with not so much an accepted offer, but in preparing to sell or to market the business for sale, right? And, same thing with a real estate transaction, whatever information you get from a broker, even a trusted person that you've worked with before, all of that information needs to be, I don't want to say taken with a grain of salt because it's not that strong, but that all that information needs to be confirmed, needs to be verified, right? If you're on the buy side, the broker should have some sort of package, not just a term sheet. They should have information related to the business itself, right? Some kind of pro forma or a setup with more than just the basic information. And once you get past sort of the initial inquiry, the initial encounter, there should be more information that's available. And the broker often acts as the conduit for the diligence materials, right? Accountants, tax professionals, both as a referral source and as a source for more information about the business itself from the seller side. And also if there are questions about valuation or anything like that, the buyer may employ some sort of accountant or other financial expert to inspect the books or make some sort of further inquiry or further evaluation of the assets or of the business of the selling business, right? Bankers and lenders, this is important from the buyer side in terms of financing. I'll talk a little bit more about that later on. Where is the money coming from for the purchase? And from the seller side, if there are encumbrances on any of the assets to be sold, just in terms of payoffs and the delivery of the assets free and clear of any liens and encumbrances, right? So at various points in the transaction, right, we may encounter and we may also engage the services of these other professionals, oftentimes in the diligence process, right? So, right, whatever our first sort of exposure is to the transaction, right, may come from one of these third parties, right? So just like a real estate transaction, there may be a deal sheet, a term sheet, a setup, some kind of letter of intent, right, with sort of basically outlining the agreed upon terms of the offer or the agreed upon terms of the accepted offer, right? Price, generally what's included in the transaction, the assets that are included, maybe some more detailed information about the seller, right? And this is, just like in a real estate transaction, this is our starting point, right? And if we are representing the buyer, once we have this sort of the basic framework, the basic outline of the transaction, we start thinking about diligence, right? And what we are going to do, right, to basically either, right, gather gather more information, right? More necessary information, and also to test, right? To test and verify the information that we've been provided. And really starts with the nature of the assets that are going to be acquired, right? What is it that our client is actually buying, right? The In most of the transactions I'm involved in, right, the greatest value of, or the most valuable asset of the business being sold is the goodwill, right? And if it's a brick and mortar business, that is the location, and so that is typically the lease, right? In a small minority of transactions, right, a piece of real property is involved if the selling business owns, right, whatever the physical location where they're operating from, right. They may also be selling the actual real property, but more commonly it's the leasehold, right? So as at a bare minimum, if that's the case, right, if your client intends to buy the assets and continue operating a similar business or even a different business in the same location, right, we start with the lease, right? The flip side of that, right, as I mentioned before, is in a lot of these businesses, right, the tangible assets are less valuable, right, as just as a practical matter, right. If you're talking about a restaurant, right, there may be some equipment that is of value, right, to the extent that the operator of the restaurant actually owns the equipment, right. So whatever's in the kitchen, the appliances, things of that nature, right, there may be some value there, right. But most of the tangible property used to operate the business has, relatively little value, right. The furniture, the cutlery, the glassware, the flatware, right? All that stuff, right? Whatever it's worth is usually a very small piece of the pie, right? And those types of tangible assets do not require much diligence at all, right? So we need to, once we have an understanding of what's included and what is the nature of the assets, then we can sort of come up with a diligence plan, right? How much diligence we're going to do, what do we need to review, how much is this going to cost, and how long is it going to take, right? Now, the other piece of this, the other consideration is, or one of the most important considerations is cost, right? So these small business transactions, right? The consideration involved is most of the time less than what the typical real estate transaction purchase and sale price is, right? So I just closed a dry cleaning, the sale. I was representing the seller of a dry cleaning business that closed last week or 2 weeks ago. And the total consideration there was, a few $100,000, right? Less than, what the average apartment costs in New York City, right? And the reality, right, the business reality is that how much diligence we're going to do, how much time we're going to spend, how much resources we're going to allocate is directly informed by the cost, right? The sale price, the purchase price, because that's our, right, ultimately that's our client's risk, right? That's our client's sort of all-in risk is what they're paying for the assets. And if we have a $500,000 transaction, it doesn't make any business sense to spend $50,000 or $25,000 or whatever the threshold is, doing our due diligence, right? So we're informed by sort of the degree of risk, right? What's the likelihood of this coming to pass, and also what is our client's ultimate sort of exposure if that risk does actually turn out to if the worst case scenario happens, right? So there's always the sort of the CYA element of it from the attorney standpoint. Look, here's what you should do, or here's what you might consider doing. And then, if they don't want to do it, if they don't want to spend the time, if they don't want to spend the money, again, that's your client making business decisions, but they're making informed business decisions rather than just, uninformed business decisions. Oftentimes, if you are representing the buyer, right, this is someone who starts off with, they refer to you and they say, well, look, I'm buying this business, or if I'm starting a business and, I don't want to do this as a sole proprietor, or, what are my options, right? If they are people who are sophisticated or more sophisticated entrepreneurs, they may already know what entity they want to create. They may have an existing entity, but this is often part of the advice to the buyer, right? A conversation about, hey, can you help me form a corporation or a limited liability company? So this is a conversation you're likely to have at some point, and you can advise your client generally or more specifically about the benefits and the requirements of each. I'll just throw in a note here. If you are dealing with more than one individual who is going to be part of the buyer, right? So, hey, me and my friend Jimmy, we have an opportunity to buy this pizzeria, and we're going to be partners, right? Be sure that you are covering your behind with regards to any potential conflicts of interest, right? So the buyer may, in fact, end up being one of these non-natural persons, right? One of these entities, a corporation or a limited liability company. If there's more than one member, you need to be very clear about who it is that you are representing. If you're representing the entity, if you're representing one of the members, if you're representing both of the members or shareholders, right? That's where you have potential conflicts, especially if you are helping them create organizational documents like an operating agreement or a shareholders agreement, right? Three members of an LLC going to execute a shareholders agreement or an operating agreement that you're going to draft. Which one of those individuals are you representing, or are you representing the LLC? And you need to make sure that the individuals who you are not representing understand, like, that you are not representing them, and that there may be potential or actual conflicts of interest in the process as they go along. And if an actual conflict arises, you need to be aware of that and act accordingly, right? When the business fails and all of a sudden the members or the shareholders are not friends anymore, Jimmy and Sal are not friends anymore because the pizzeria, they lost all their money in the pizzeria, and then they're looking for potential claims, and they're looking for potential people to blame. You don't want that to be you, right? So just something to keep in mind. Similarly, if you're representing the seller, and the seller is an entity, a corporation, or a limited liability company, make sure that all of the necessary parties are on board with the transaction, and that you are dealing with a person who's authorized to act on behalf of the entity, right? And at some point you'll need some consents, and part of the closing deliveries, the seller's closing deliveries, are typically some memoranda, some document that memorializes the authorization of the transaction. The same way as if you were representing an LLC selling a property, right, where title would require some sort of corporate resolution right, as well as some statement regarding the authority of the entity to complete the transaction. So something to be aware of on either side. Um, so one of the first conversations, or one of the first things I ask a buyer, if I've not dealt with them before, is, where is the money for this transaction coming from? If the buyer is getting financing, right, are they going to try to get a small business administration loan? Are they getting funding or some other sort of bank loan? Are they going to a hard money lender, right? Where, ultimately, how are they going to pay for this, right? The It's not uncommon in these types of transactions for the seller to hold paper, right? For the seller to finance some part of the purchase price, right? The So if the seller is going to finance part of it, right, one of the closing deliveries will be a promissory note. The seller may want to retain a security interest, so the assets that are being sold to the buyer are pledged as collateral. That would be the same type of setup with if you had any sort of third party financing in the transaction, as well, right? And sort of just going back one step, if the buyer is an entity, right, and there is financing involved, especially if you're representing the seller, you want to make sure there's a guarantor that is a financially responsible individual who is going to be, guaranteeing the payment obligations, or either signing the note directly or signing a guarantee of the note. And certainly, I think that you need to discuss and recommend to your client, the seller, that they do require some security, some collateral, for the note and for the obligation, right? The reality is that most of these, I shouldn't say most, a fair percentage of these businesses fail, right? Small businesses generally fail. Also, right, given the nature of these businesses, they often don't survive the transfer of ownership, right? So how often do we have like a favorite restaurant that we go to that's been great, we love it, neighborhood place, we always go, and then you see the sign under new management, or you find out that it's under new management, and all of a sudden the place sucks, right? Maybe it's maybe it's sort of like chicken and egg type thing where, you find out it's under new management and then your perception of the place changes, or maybe it's real sort of changes, right? But that's not an uncommon thing for a variety of reasons, right? A lot of these transactions, the buyer does not succeed, or does not continue for an extended period of time after acquiring the business. So you want to make sure that if your seller is holding paper, and especially if the term of the loan, if it's an extended term, you want to make sure that they're sufficiently protected. The Of course, the seller would prefer to get all their money at closing, but the reality is that sometimes the buyer is just not in a position to get third-party financing. Right? So we want to be sure that we're protected. So I already talked about identifying the assets and the liabilities, what's included and what's excluded. So, you might get some document from a broker, you might get some document from the parties that has a list of what's being sold and what's not being sold. So it could just say, substantially all of the business assets, or all of the assets of the business, right? When you are preparing the closing documents, which is typically a bill of sale, you probably want to be more specific than that. Obviously, if any of the assets that are being transferred, being sold, are titled assets, right? Like maybe there's a motor vehicle involved, maybe there's really I can only think of other than real property, right? There may be some actual document evidencing ownership of that particular uh, asset that needs to be transferred, right? But typically, when we're talking about um, uh, chattels, right, personal property, there is no title document. So the document that we use to convey ownership is a bill of sale, right? And there's a couple of examples. I gave some examples there. There are in the documents, and I'll take a quick look at those in a little bit, right? But what's actually included, and how are these assets valued? This is important because the transaction is considered a bulk sale, and sales tax must be collected and paid in connection with the transaction. So there's a tax reporting form. It's the AU 196.10. This is a New York State Department of Taxation Finance. It's a form, right? And this form must be completed and filed with the New York State Department of Taxation before the closing date. And typically, not typically, you're required to submit a copy of the asset purchase agreement, the contract, along with this reporting document. And the filing is required to basically do two things. Number one is the New York State Department of Taxation confirms that the seller does not owe any sales tax, right? So the seller, if depending on the nature of the business, if they're required to collect and pay sales taxes, right, you want to make sure that they're not delinquent in that obligation. And the other part, the other function of the form is that the tax department then determines how much bulk sales tax is owed on this transaction, right? And the tangible assets, right, are taxed, and the intangible assets are not taxed. So what's intangible? The leasehold, goodwill, right? The actual, physical assets are taxed, and the buyer pays the sales tax, right? So what happens is after the AU 196.10 is filed, right, you'll get basically two correspondence from the tax department. One says, hopefully, seller doesn't owe any sales tax, and the other says buyer has to pay this much in sales tax in connection with the transaction. So as a reality, right, as I mentioned before, most of the most valuable asset is typically the goodwill, right? However, right, you can't be unreasonable in your allocation of value, right? If you are right, the tangible assets have to have some value, right? Otherwise, right, you are subject to audit, and you're subject to audit anyway, right? So the figuring out how you are going to allocate the purchase price by and between the included assets is important and has a direct financial impact on the buyer, right? But it should be defendable, right? Like anything else, if you are, putting something on a tax reporting form, it shouldn't be crazy. And if required to, you should be able to defend those valuations if need be, right? So what kinds of assets are we typically talking about? Real property, right? If there is real property being sold as part of the business, right, you would have then a deed, and you would have whatever, the New York City, New York State transfer taxes, depending on where the real property is located, and you'd have a title, you'd have title work done, and that would sort of take place within the framework of the overall transaction, right? The leasehold I mentioned, fixtures, equipment, supplies. I'm going to pass over inventory, come back to it, right? Intellectual property, goodwill, accounts receivable, existing executory contracts, right? If this is, if any of these are included, right, in your transaction, there's due diligence that needs to be done, right? We're all familiar. If you're a real estate attorney, you're all familiar with the due diligence that needs to be done with regards to real property. Leasehold, obviously inspect the lease, fixtures, equipment, and supplies. If those need to be physically inspected or value appraised, anything of that. Intellectual property, you want to make sure that your seller actually owns what it is that they are going to sell. Goodwill is just the ongoing sort of we could describe it as basically the revenue stream, but it's the ongoing sort of existence of the business at its present location, typically, right? Inventory is its own animal, right? And the thing about inventory is that you can consider it an asset or not, right? What is the actual value of inventory, right? The seller has paid money for it, right? But the longer inventory sits on a shelf or in a warehouse or in storage unsold, the value approaches zero, or actually at some point it becomes a liability, right? So, you go into a retail store and you see an item of clothing that was originally on sale for $100 and now they're selling it for $5, right? Right, selling it at a loss because it's been on the shelf, it's been hanging there for a year, and it costs them more money now to store it and move it back and forth from the storage room to the shelf than what they paid for, right? So depending on the nature of the business and the product, right, the valuation of inventory may be difficult. Also, right, if we have an ongoing business, right, we're going to sign our contract on May 14th. We're not going to close until July 1, right? The inventory is going to fluctuate because the seller is going to continue operating the business. The buyer wants the seller to continue operating the business. So, right, the inventory is going to rise and fall. Oftentimes in the contract, we'll put in some limitations or some guidelines about the ongoing purchase of inventory during what we call the executory period between the time the contract is signed and the closing, right? Some limits on the purchase of inventory, right? We don't necessarily want the seller to buy excess inventory or spend a lot of money on inventory during this period between when the contract is signed and when we actually close. It's also not uncommon for there to be some reevaluation, right, or some reassessment of the value of the inventory closer to the closing date or even post-closing, right? So there may be some amount of the purchase price allocated to the inventory in the contract, and then that's subject to adjustment after closing, right? Buyer comes in, now the buyer has actual possession, says, wait a minute, this inventory, there was supposed to be 1,000 pieces. Now there's only 800 pieces, or, something along those lines. So, it really depends on the business, and it depends on what the product is. Once had a deal involving a furniture store, right? And there was a whole bunch of inventory that the buyer thought was worthless. And the seller said, no, it's not, because it's seasonal stuff, right? So there was a bunch of inventory sitting in the warehouse that was basically like patio furniture, chaise lounges, umbrellas, things of that nature that, was sitting there for, 6 months or 8 months or 9 months. So it shows on the records, it shows that it's aged, 180 days. But, no one's buying patio furniture in December, right? So you really need to be sort of in tune with what's actually going on, what the product is, and understanding sort of the business, especially if it's a seasonal business or something along those lines, right? Christmas decorations, in your warehouse in March may not be a good sign, because maybe they didn't sell from the past Christmas, or maybe you're getting ready for Christmas 2025. So you need to sort of be aware of, or at least thinking about these differences, right? And that gets us back.
Popping in real quick to give the course code. The course code is contract. The course code is contract. I will also write it in the chat.
Thanks, Diana. So just again, just coming back again to right revisit diligence one more time, right? Because again, it's informed by the nature, the subject matter of the transaction, which is the assets, right? And where does the value lie, right? And your diligence plan, right, should be made based on a value risk assessment, right? Uh, what assets of what categories of assets are the most valuable, expensive, and what are the risks or what risks may be associated with that, right? And as I mentioned before, most of the value in these kinds of businesses is goodwill, the leasehold, right? At the very least you should be doing is examining the lease and not just for or taking for at face value what a broker says the rent on the property is, right? As we uh, as we know, or we may know, right, there are additional costs that are in the lease that are beyond the rent, and especially, sort of the duration, the remaining term, any options to renew, any landlord options to terminate, right? All of this affects the value of the leasehold from the buyer's perspective, right? So switching gears now, what about if we are representing um, the seller, right? And the question I brought up before is what kind of diligence should the seller do, right? If I have a client who comes to me and says, "Hey, you know what, Mike, I'm thinking about selling the business because I want to retire or whatever. I'm tired of doing this, right?" The diligence I would suggest to them is, look, starting to get ready for the transaction, right, is the same way you would, have your house painted or have your landscaping done if you are going to market your house for sale, right? You want to make sure that your ducks are in a row, anticipating what the buyer is going to be looking for, right? So, when I say clean up your books, I don't mean doctor your books or misrepresent any information, but make sure your business records are in good order, right? Make sure that the information, anticipate what kind of information the buyer is going to be looking for, and have that at the ready, right? And make sure that it's presentable, and make sure that it's someone looking at it, someone inspecting the books is going to see that you are a serious business person, and that you're doing what you're supposed to be doing, right? So you're going to anticipate what the buyer is going to ask for, right? You're also going to require some confidentiality, right? Your expectation is that this deal is going to go through, right? But you want to make sure, first of all, that your buyer is bona fide, right? That they have a legitimate interest, right? They're not just wasting your time, and any information you're going to give to them is going to be kept confidential. I mentioned this before, corporate consents, right? So maybe you have two or three partners, right? Maybe they are silent partners, they're investors or whatever, right? Folks who are not involved actively in the business. What do your corporate documents require as far as consents to the sale of the transaction, right? Do you need to have everyone on board? Does it need to be unanimous, right? What is the procedure that you need to follow to get these corporate consents? Make sure, right, that again, everyone's on board, especially from the attorney side, right? I had this come up one time. It was representing someone who was selling a restaurant, and after the restaurant was sold, we're closed, right? And 3 months later, I get a call from someone saying, "Hey, did you represent so and so when they sold the apartment?" Yeah, look, I was their partner. What happened? And not anywhere on the corporate books, not anywhere on the records, not anywhere on the corporate tax returns, right? didn't really have a leg to stand on, but that's the type of thing that you want to avoid, right? When we close, we want to be closed. We want to be done with things, right? Um, Landlord consents. One of the most important, if the leasehold is one of the most valuable assets, obviously it needs to be assigned to the buyer. And that is going to, I would say almost in every circumstance, is going to require the consent of the landlord, right? The lease, your commercial lease should lay out a process for obtaining the landlord's consent, right? And should lay out a process for the assignment, right, of the lease to a buyer or a third party, right? This is often an opportunity for the landlord to realize a little more financial consideration, right? Fees associated with the assignment of the lease. Also, there may be some there may not only for the administrative part of it, but for the actual assignment itself, right? Really just depends on the circumstances. If you are renting in I had someone many years ago who was renting a retail space in Grand Central, and they wanted to sell it. And when they, as a condition of the assignment of the lease, basically the landlord got a piece of the consideration for the sale of the business, right? So it really depends on what the lease says. So from the seller side, you need to be familiar with what's required, and you should get out in front of that, when you start the process. Regulatory issues are rare in these types of transactions, but if there are, more sort of common is the transferability of licenses, right? Or different kinds of authorizations, right? In gas stations, for example, if you're doing New York State DMV inspections, right? There's machinery that's involved. There's authorizations that are issued by DMV, right? If you're a restaurant, if you have a liquor license or something along those lines that you want to transfer, right? You need to be familiar with what's required to make that happen. If there are any existing liens and encumbrances on the assets, right? So maybe you have a business loan and you pledged the business assets as collateral, right? Those liens need to be removed. So you need to arrange for payoffs and the discharge of the liens, and then taxes, sales taxes that you might owe, and also taxes that might be due or tax consequences on the sale of the transaction from your perspective, right? So these are all conversations, things that your client, the seller, should be thinking about in preparation for the transaction. I mentioned before payment terms, right? Again, like any other sort of asset transaction or similar to a real estate transaction, typically there'd be some good faith upfront money, and then a closing payment. And getting back to this question of seller financing, right? Does it make sense if the seller is going to finance part of the purchase price? You may want to do some vetting of the buyer. And as I mentioned before, it probably makes sense to hold some security interest in the assets themselves. Adjustments, right? At closing, we would typically adjust for rent, security deposit, water, any other sort of operating costs that are transferable, right? And then post closing, I mentioned, if there's some adjustment for inventory or some other asset class, that should all be provided for in the contract. Couple of other sort of features that are not uncommon. So post-closing assistance or transition with the business. So it's not at all uncommon for the contract to say that the seller is going to stay on for some period of time after the closing to sort of help the buyer get their sea legs or or to get up and running with the business to assist with the transition, right? Sometimes there's additional consideration for that. Maybe like if one of the principals of the seller is going to stay on, they'll get paid a salary or some sort of consulting fee, right? But something to think about, especially if the seller is holding paper, if the seller is giving financing, it's in their interest for the business to succeed. So helping the buyer out is in the seller's best financial interest. Restrictive covenants, right? So because the goodwill, right, is a lot of the value of the transaction from the buyer's standpoint, they don't want the seller, selling pizzeria A and then the day after the closing, opening up pizzeria B on the other end of the block or across the street, right? So there's typically there'd be some restrictions on the seller opening a competing business, also non-solicitation of clients, non-solicitation of employees, right? All the things that would impede or would make it difficult for the buyer to actually continue running the business successfully. Your seller really shouldn't give many representations, but certain representations maybe as to the value of assets or the corporate books and records, those may survive the closing. And it's also typical for there to be an escrow. I mentioned the AU 19610. That requires that an escrow be held until the waivers are delivered, but it's also common for the buyer's attorney to hold some escrow post-closing against the claims of any claims of general creditors that may come to light once the transaction has closed. All right, I think it's 2:00, so I'm out of time, right? Do I have time for some questions?
Do you have two or 3 minutes for a few
I can stay, sure, yeah, absolutely.
Okay, it is now 2:00. You have the code. You are free to go if you want, or stick around for a couple questions. I'm sure people will stick around, but I just wanted to let you know if you need to go, you can. I have a few quick questions I will ask. One, do you have a go-to company for obtaining business due diligence reports?
I do not. You could do, I would typically start with at the very least, a lien search, right? The truth of the matter is that a lot of small businesses are not going to turn up in like what you would typically, these services that provide these sort of business profiles, right? Like Dun and Bradstreet or whatever the analog is. You can find out a lot of information by yourself in terms of just simple sort of Google searches or searches of public records. But definitely a lien search and right, a UCC, which would turn up UCC filings, and a judgment search, which I'm sure Judicial provides a service similar to that, right?
We do. We can do a business search, depending on where the business is located, we can do that. Yep. As a buyer, do you prefer C or S corporations or LLCs?
Well, I think it really depends. So if you are going to be a single, right, if there's going to be one shareholder, right, so when you form a corporation, the default is an S corporation, right? A C corporation. You have to make the S corporation, right? The S corporation is an affirmative election that the company has to make, right? Single member, I think an LLC makes more sense just because it's more flexible, right? Oftentimes, like someone starting a business objects or has the problem they have is that it costs more money to form an LLC because you have to do a publication, right? So the cost to form an LLC is about 5 times as much as what it costs to form a corporation, depending on what county you're in, because you have to publish a legal notice. So for a single member entity, I don't think it really makes a difference. If you're going to have more than one person involved, I think an LLC is better.
Is the AU 196.10 filed in stock purchases?
Stock purchases? No.
Post-closing, this is a bar for sale. What happens if the seller left items such as a bar, refrigerator, and it turns out there was lien on certain items. What do you do with the inventory? Can you still use it?
Well, hopefully that wouldn't happen, right? I think the problem is that, if the lien holder comes back because the seller's not paying, right? Those items that are the collateral are subject to foreclosure, right? Repossession. Whether or not the lien holder would actually do that, I think depends on who the lien holder is, right? A lot of times, companies that are, providing those, like the company that rented that equipment, right? If it's rented, they will come and take it back, right? If it's a bank and it's sort of just a general pledge of all of the business assets as security for the loan, it's less likely that the bank is going to come back and grab your soft drink fridge or something like that. So, yeah, you can continue to use it until someone comes and repossesses it. Yeah.
And one last question. Can you comment on how to handle, as buyer and as a seller's attorney, outstanding gift certificates previously issued by the business but not yet redeemed?
Yeah, I think that the seller should give a credit for that, to the buyer, right? Because the seller realized the value of those. Someone paid for those, and the buyer is going to be redeeming those. So I think, in an ideal situation, there would be some credit, and that requires that the seller, keep a good account keep good records of that, and that, they be accounted for. But that would be sort of best practices, I think.
Great. Thank you so much. Thank you, Mike, for an awesome CLE.
Yeah, for those of you who are still here, thank you for your time. And yeah, thanks, Diana.
You're very welcome. And after the lecture this afternoon, I'll resend everyone the material, the affirmation, the evaluation, so you all have it. And we will see you next time.
Bye. Bye-bye.
Thank you.